Present transcript. Financial analysis of the EVAL vs China Airlines and the agenda. Good morning, everyone. Today, our team will present a financial analysis report EVAL vs China Airlines. In this session, we will dive into the performance of Taiwan's two aviation giants, show an industry overview, company profiles, and the vertical financial analysis. Our presentation today will begin with the industry characteristics, followed by a look at each company's background, and finally an analysis of their profit moment. Page 1. Industry overview and competitive strategy. First, let's look at the overall environment of the aviation industry. 1. Industry characteristics. The aviation industry is a high capital, high risk, and highly cyclical sector. Revenue is primarily driven by passenger and cargo service. 2. Cost structure and risks. Operating costs are high due to aircraft acquisition, and maintenance performance is also heavily influenced by unpredictable global economic trends and international oil price fluctuations. 3. Competitive strategies. To service in this volatile market, airlines focus on optimizing fleet efficiency to reduce fuel consumption, expanding route networks to increase revenue, and leverage global alliance to strengthen market competitiveness. Next, let's introduce the two main subjects of your analysis. China Airlines. Established in 1959, China Airlines is Taiwan's largest civil aviation provider and a key member of the China Airlines. The China Aviation Development Foundation is largest shareholder, 13.69%, providing strong government-backed stability. Its network spans across Asia, Europe, Oceania, and the Americas. A member of the Newman Green Group, EVAL was founded in 1989 and is the second largest carrier in Taiwan, with a capital of approximately $70 billion. It slightly exceeds China Airlines in scope. EVAL is known for its relatively young fleet and strong competitiveness on long-haul international routes. Page 5. Moving into the financial data, we'll start with the vertical analysis of China Airlines. 1. Profit volatility. China Airlines hit a peak in cargo revenue in 2021, followed by a post-pandemic transition in 2022. 2. Cost control. By 2024, the cost of the goods sold (COGS) as a percentage of revenue jumped to 83%, reflecting the recovery of passenger travel and effective cost control. 3. Structural optimization. The company has successfully shifted from a cargo-dependent model during the pandemic back to a balanced passenger and cargo growth strategy. Finally, let's examine EVAL financial performance. 1. Superior profitability. EVAL maintained a high gross margin of 22 to 24% between 2023 and 2024, which is an outstanding performance in the industry. 2. Excellent cost control. As passenger demand returned, EVAL further reduced its operating cost ratio to 76%, Operating resilience. Its operating margin climbed to 50 to 18%, reflecting EVAL's strong resilience and efficiency in converting revenue into the profit during the market recovery phase. Transition statements. As we can see from the first 6 pages, where both the companies successfully navigate the pandemic, EVAL has the demonstrated a slight lead in cost control and profitability. Next, we will move on to the horizontal analysis and the special phase financial ratio to see the deeper trends.
Horizontal analysis. Operational volatility with cargo support. First, let's look at China Airlines. Pandemic impact. Revenue dropped by 31.6% and profit fell a lot. This showed that China Airlines was strongly affected by COVID-19. Cargo boom. During the pandemic, cargo became the main support. Gross profit increased by 128.5% and operating profit improved sharply, helping the company survive. Recovery period. In 2022, profit fell when cargo demand cooled. However, from 2023, passenger demand recovered and gross profit grew by 109.6%, bringing the company back to a normal level. Strong turnaround and passenger recovery. Now, let's move on to EVA Air. Pandemic impact. Revenue dropped by 50.9% and operating profit turned negative because passenger flights stopped. Cargo support. Strong cargo demand helped EVA Air recover. Gross profit increased by 125.8%, but EVA Air still recorded operating losses. For recovery. In 2023, passenger demand returned strongly. Operating profit grew by 201.8%, even higher than before COVID-19. Next, let's compare profitability. ROE. EVA Air recovered quickly and kept stable double-digit ROE. China Airlines also improved in 2023 to 2024, peaking at 21.29%. But its ROE trends more over time. Net profit margin. In 2023 to 2024, EVA Air kept margin at around 12% to 17%, while China Airlines stayed at 5% to 9%. This means EVA Air is better at turning revenue into profit. Now, let's look at financial stability. China Airlines, its debt ratio fell, but it is still above 72%, showing higher financial pressures. EVA Air reduced its debt ratio to about 62% in 2024, showing a stronger financial position. Overall, EVA Air has lower financial risk and more flexibility. Next is operational efficiency, measured by asset turnover. China Airlines efficiency dropped in 2020 but recovered strongly, reaching over 16% in 2023 to 2024. EVA Air efficiency recovered more slowly but stayed stable over time. It's recovered steadily from 2021 and stabilized at around 10% to 15%, showing better resistance to economic change. China Airlines show better improvement while EVA Air is more stable. Finally, let's look at market valuation. In 2020, both companies had a very high PE ratio due to losses. As profit recovered, PE ratio returned to normal. Overall, EVA Air's PE ratio is more stable, showing higher market confidence. Financial summaries. This data chart shows the 2024 finance performance. EVA Air performs better in ROE and profit margin. China Airlines has higher asset turnover and higher debts, showing more use of leverage. Overall, EVA Air is more stable, while China Airlines focuses on efficiency and scale. Based on all indicators, EVA Air shows a clear overall advantage.
Today we are looking at Taiwan's two airline giants, China Airlines and EVA Air. Travel is back and booming. Both companies want to win, but they have very different styles. China Airlines has government support and a huge cargo business. EVA is known for its great brand and strong finances. Today we will see which one is a better choice for investors. First, let's look at China Airlines. China Airlines is strong because it has the government behind it and a very big network. This cargo business is like a money machine for them. People love China Airlines because service feels warm and the food on long flights is great. But China Airlines has a problem. Their costs are high and they have a lot of debt. This makes it risky when oil prices go up or if there are labor problems. Now, let's talk about EVA Air. EVA is all about quality and efficiency. They are famous for being safe and professional. Their planes are newer, which means they have more fuel and are better for the environment. EVA is very smart at flying to North America, where they make a lot of money from business travelers. Even though they sometimes have streaks, their customers are very loyal because their service is always top-notch. So how should we choose? It depends on what you need. China Airlines is great for flying within Asia or to Australia. Their prices are usually a bit lower. EVA is like the star students. Their cabins are modern and very clean. Even if their tickets cost a little more, people feel it's worth it for the better service and rewards. Simply put, China Airlines wins on size, but EVA wins on quality. Numbers don't lie. This is where EVA really wins. In the last 2 years, EVA's profit margins were much higher than China Airlines. Also, look at their debt. EVA's debt is under 65%, when China Airlines is over 72%. This means if the market gets tough, EVA is much safer. For investors, EVA is like a safe bet because their performance is more stable. To wrap up, both airlines are doing well now, but if you want a company with a stronger foundation, the answer is EVA Air. They have a better brand, better operations, and better finances. If you are looking for a safe and stable investor, EVA is the way to go. This is our references. It's our presentation today. Thank you for your listening.